Hi, everyone. Thank you for joining me today for part one of our taxpayer education series. My name is Zara, and I'm the staff attorney working in the Low Income Taxpayer Clinic with the Erie County Bar Association Volunteer Lawyers Project. Today's program is going to be focused on tax filing basics. So I want to talk a little bit about the Low Income Taxpayer Clinic program first, and then we're going to get into the fun stuff. So in terms of tax filing basics, we're going to focus on filing status, filing obligations, and refundable credits. So this is just a little bit of information about the Low Income Taxpayer Clinic program. In 1998, the IRS Restructuring and Reform Act was passed. This is important because it authorized the use of dollar-for-dollar matching funds to be used for the LITC program. The primary objective of the LITC program is to protect taxpayer rights by providing access to representation for low-income taxpayers. The goal being that achieving a correct outcome in an IRS dispute should not be dependent on a taxpayer's ability to pay for representation. I believe the statistic is that a unrepresented individual, I apologize, a represented individual is twice as likely to get a favorable or correct outcome in a dispute with the IRS as opposed to an unrepresented individual. And that could just be attributed really to a number of factors. But a lot of times people are unaware of their rights as taxpayers. Sometimes there's a communication issue, especially across cultures. So representation becomes very important in these situations. In terms of the work that we do, this is by no means an exhaustive list, but we represent taxpayers in controversies with the IRS. So the most common cases that we see are injured and innocent spouse claims. We provide representation for a wide range of audits, but most commonly audits for the earned income tax credit, dependency exemptions, and filing status. We also assist with offers in compromise, which is essentially a negotiation or settlement of tax debt. We assist with worker classification and the removal of levies and liens. And finally, we do see a lot of identity theft relating to your tax return, your income or refund claims. So we can provide assistance in that regard. Okay, on to the fun stuff. So some tax filing basics. One of the most important things in filing your tax return is determining what your filing status is. This is really important because it becomes important in determining whether or not you need to file a tax return, how much your standard deduction will be, and ultimately the amount of tax that you owe. So some important factors in determining your filing status and your obligations is your age, your marital status, whether or not you have dependents. It is very important to note that your filing status is determined as of the last day of the tax year. So life can change very quickly, especially as we've seen in 2020. But your filing status really your filing status is really based on the information or the situation as of December 31st of that year. So for example, if you were unmarried up until November of 2020, which is still to come, but yeah, if you're unmarried, then you would, but you got married November of the tax year, then your filing status would have to either be married filing jointly or married filing separately. So it really just depends on your situation as of December 31st of the tax year that you're filing for. Okay, so what are the different filing statuses? There's single, married filing jointly, married filing separately, head of household, and qualifying widower. Each of these have different implications. So our next tax program is actually going to focus on married filing jointly and married filing separately, and some of the benefits and drawbacks of both options and why that becomes important down the line. So please stay tuned for that. In terms of how your filing status impacts your filing obligation, this is a table with the information for the 2019 tax year. But if you look at, we're going to compare the age group of under 65. So if you use the single filing status, then you are obligated to file a tax return if your income is $12,200 or more for that tax year, versus head of household. So if you're unmarried but you have dependents, and again, we're going to look at the under 65 demographic, the filing threshold is a little bit higher. It's 18,350. You compare that to married filing jointly, it would be 24,400 between the two spouses. So if only one spouse works, there's a little bit of a benefit there. Okay, so what are the sources of taxable income? Income comes in many forms. This is by no means an exhaustive list, but generally, income from employment, we see that it's very common. Your employer should issue you a W-2. Now, if you're self-employed, you can use Schedule C to report income and business expenses. If you're an independent contractor, you receive 1099s. Some of the less common forms of income that people think about would be cancellation of debt. So if you owe a debt to a commercial, whether it be a mortgage or a credit card debt, we see a lot of that, and it's canceled for less than the value that you actually owe. The canceled debt actually counts as income and it's taxable. You should receive a 1099-C for that. Now, there are certain exceptions, but generally cancellation of debt is taxable income. So if you are in that situation, please feel free to reach out to our office to see if you're eligible for any of the exemptions. But unemployment is also taxable, which is not very popular, of course. And I know that this year, unfortunately, a lot of people had to resort to unemployment, but it is taxable. So you would get the information from your 1099-G and report that on your tax return. Okay, so what if your income is lower than the filing requirement? Should you file a tax return anyways? Any takers? Okay, so in many cases, yes, you should file a tax return even if you are below the filing threshold. So consider the following situations. If you had money withheld from your wages throughout the year, but your total income was lower than the filing requirement, then you can file a return to recover the income tax withheld from your pay. You can also recover overpayment of estimated tax payments for the year. And this is my personal favorite. You could be eligible for refundable credits. So a lot of people don't know that they're refundable credits, and in order to claim them, you have to actually file a tax return. So that's really one of the most important reasons to file a tax return, even if your income is below the filing threshold. So that brings me to the difference between non-refundable versus refundable credits. So a non-refundable credit means that the taxpayer will get a credit only to the extent that they owe money. So you will not be issued a refund for the amount that the credit exceeds your tax liability. So for example, the mortgage interest credit is non-refundable. And just as a hypothetical, these numbers are not very accurate, but if you were entitled to a mortgage interest credit of $300, but you had a tax liability of $100, since the mortgage interest credit is non-refundable, it will reduce your tax liability to zero. However, you will not receive that remaining $200 back as a refundable credit. Now, compare that to a refundable tax credit where the taxpayer is issued a refund for the amount that the credit exceeds the tax liability. The most common and largest refundable credit is the earned income tax credit. Just for the sake of simplicity, you can use the same numbers. So if you were entitled to $300 for the earned income tax credit and you had a $100 tax liability, the earned income credit would reduce your tax liability to zero, but you would also get that $200 back as a refund. Okay. So I used the earned income tax credits in my last hypothetical. I just wanted to expand a little bit more on that. The earned income tax credit is the largest need-tested anti-poverty cash entitlement program. To be eligible, you do have to file a tax return, and there are certain other requirements. So you have to have a social security number that's valid for employment. You cannot be the qualifying child of another filer, and most importantly, you have to have earned income. So I mentioned earlier that unemployment is taxable. This is one of the not so great situations where unemployment, even though it is taxable, it doesn't count as earned income, so it wouldn't count towards the earned income tax credit. But if you're a wage earner, if you're self-employed, independent contractor, that would qualify you for the earned income tax credit if you meet all of the other requirements. And the IRS actually has a great tool. It's publication 5334, which is, it really functions as a flow chart, and it helps you determine whether or not you qualify for the earned income tax credit. Okay, so this is just a little bit more information about how you can find out whether you're eligible to claim the earned income tax credit. So as I mentioned, publication 5334. There's also an assistant tool that you can find at this link on the IRS website. So another really great credit is the child tax credit. This is a credit for individuals who claim an eligible child as an independent. It is in addition to the child independent care expenses and the EITC. The child tax credit is refundable up to $1,400. So it's not fully refundable like the earned income tax credit is, but it is to a degree. There's also a credit called the credit for other dependents. The maximum amount that you can claim for this credit is $500 for each dependent. Now, it's important to note that the person that you claim for the credit for other dependents cannot be used by you to claim the child tax credit or the additional child tax credit. And you should just know that it is non-refundable. Okay, and finally, some resources for tax filing. This was, I think, a lot of information. So it would be slightly unreasonable to assume that you should remember all of it, but luckily there are a lot of resources in the community that can assist. Although our office doesn't actually file tax returns, the volunteer income tax assistant program, so the VITA clinics, do file tax returns for low-income taxpayers. There's also tax counseling for the elderly, and then there's also some free tax preparation tools on the IRS website if you feel comfortable doing that. But yeah, so these are some resources for tax filing, and if you just take the appropriate documents to the tax preparation sites, they will be able to assist you with determining what can be excluded and what credits you qualify for. So, does anybody have any questions? Okay. Well, thank you for tuning in. I just wanted to include our contact information. So if you or somebody you may know, if you receive a letter from the IRS and you're really not sure what to do, please do not hesitate to reach out. But also if you just have general tax questions and you're in a situation where you're not really sure what the tax treatment would be of a certain situation, please do not hesitate to reach out. We are still operating remotely, so I have included our address, but really the best way to get through to us is by telephone. So it's 716-847-0662, extension 316. You can also email me directly, or we actually also have recently launched a web submission form that you can find on our website, ecbavlp.com. And if you just go under the Low Income Taxpayer Clinic tab, you should be able to submit a web submission form. So thank you so much for tuning in, and please do not hesitate to reach out.